Good morning, everyone. Thank you for coming today. My name is Christine Short, and I'm VP of Research at Wall Street Horizon. Wonderful to see you all here. We have an exciting program lined up for you. For those of you that are unaware, Wall Street Horizon curates extremely accurate forward-looking corporate events data so that you make and don't lose money. We support institutional clients with an edge for your investing and trading needs, and we're very happy to have you all here today. This is our 6th Data Minds event. We're happy to host it, help you gain access to some of the best independent minds and thinkers in the field. So listen today, ask questions, and connect with any of the speakers afterwards. Now on to our program. I'm going to introduce you to our moderator for today's session, Virginie O'Shea, founder and CEO of Firebrand Research. Virginie is a capital markets fintech research specialist with 2 decades of experience in tracking financial technology developments in the sector, with a particular focus on regulatory developments, data, and standards. Most recently, she was a research director with IT Group, heading up the institutional securities and investments practice. I think you're all going to learn a lot today. So without further ado, Virginie, the floor is yours.
Thanks very much, Christine, and welcome to everybody that's attending today. And hopefully we'll have a great discussion, as Christine mentioned. We're going to be discussing the risks that everybody should be thinking about over the next 11 months and beyond. Every year, the DTCC publishes a risk barometer that highlights the greatest concerns of its community for the coming 12 months. And at the end of last year, the top concerns that I saw cited by respondents were, unsurprisingly somewhat, cyber risk, the impact of infectious diseases, step forward coronavirus and all the variants that we've been dealing with, unfortunately, geopolitical risk, step forward Russia and what's going on there at the moment, and climate change. So lots of different topics that we could talk about today, and many other things as well. These are all things that have been impacting our day-to-day lives, as well as those of the operations of financial institutions across the globe. Now, as you can see, I've got a great panelist lineup here with me today to discuss everything from the macro perspective of how to deal with the volatile markets we're currently living with, through to the thrills and spills of things like dealing with crypto assets and the fast evolving world of ESG investment. Now, before we kick off the questions, I would like to get each of my panelists to briefly introduce themselves. So I'll start with you, Melissa.
Oh, thank you, Virginie. I'm Melissa Brown. I run the Applied Research Department at Qontigo. For those of you not familiar with Qontigo, we were formed a couple of years ago as a combination of Axioma, an analytics business, and stocks, the index business.
Fantastic. And Elliot?
Thanks, Virginie. Hi, everyone. I'm Elliot Worth. I'm a product manager at FactSet. I specifically look after the open FactSet marketplace, and within that role, I work with a lot of our third-party data providers and vendors, and helping them get their products and solutions seen by our client base.
Good stuff. And Chris?
Hi, everyone. Chris here, founder of CP Capital. We're a data consultancy focused on building out data strategy efforts for data buyers, mainly hedge funds and venture capital shops in the audience today. And we also work with data sellers, such as vendors, to bring data products to market.
I think you're on mute. Are you
John, apologies. Yeah,
oh.
got stuck there.
Yeah. My name is Jon Trowbridge. I'm the Senior Director of Risk Management for TradeStation. For those of you that aren't familiar, TradeStation is a brokerage firm based out of the US. We specialize in equities, futures, and cryptocurrency. I have 17 years in financial risk management in the brokerage space, as well as the commodities trading and commodities processing space. I specialize in OTC derivatives, equities, futures, fixed income, currency, and cryptocurrency.
Fantastic. Some of the topics that I was mentioning earlier. So we've got a great panel here to discuss all of the different risks we need to think about pinging on the radar out there. Now, before we kick off, I'd like to launch our poll just so that you guys have a chance to share what your primary risk concerns are for the coming 11 months now, I guess, since as January has sped by. So if you would like to look at your screens and select the primary risk concerns, and there's a list there. And if none of those risks resonate with you, please click other, and we can discuss that later as well. While everybody's answering the question, I don't want any dead air, so let's start with our first question. As we're in the first quarter of the year, a lot of firms are reviewing their risk management activities and everyone's preparing for what's going to hit us this year. So I'm going to ask my panelists, what do you think we've learned as an industry over 2021, and what kinds of trends can we expect to see influencing firms in 2022? Melissa, let's start with you.
Yes, thanks, Virginie. There are certainly a number of trends. I think probably what I'm going to talk about won't be wildly surprising to anybody, but what really started to happen in 21, which had not happened for many years, were the kind of dual specters of inflation and higher interest rates. And that is something that we're hearing from our clients is one of the major concerns. How do we deal with these new risks that, frankly, we haven't seen for a long time? So one of the issues that we were seeing last year was the argument that equities were the only game in town. You weren't getting anything by investing in any kind of fixed income. But that's really no longer the case. And even later last year, we've seen people moving to alternatives, to private equity, to real estate, and that becomes a different animal in managing that risk. It's a very different set of risks than just looking at plain old equity risk. Not that there's anything plain old about equity risk, but you have other issues like the infrequent pricing of some of these illiquid assets that now people have moved their money into. So we need to understand these risks better. On the inflation front, one of the things that concerns me is that many of the participants in the market today haven't really seen inflation. We haven't had high inflation for a very long time. I remember it, but I think many people probably don't. And that makes it, when you've never seen it, it makes it very difficult to know how to navigate it. We've got the question of whether it will last. And if it does, then how do we hedge inflation? So, we're seeing more hedging products come out the door, for example. There's certainly, if we had all day, I could certainly probably talk about this all day. One other thing maybe that I would mention is within the equity space, one of the big discussions is growth versus value and what's happened there, and have we seen the change that's not just temporary, but is value coming back? And if that's the case, then how do I manage the risk of my portfolio that if I'm just in a benchmark is heavily skewed towards growth? So those are just some of the issues that started to come up last year and that I think are continuing to go forward for this year.
Sure, fantastic. And I'm just going to end the poll so that people can see the results of that. Let me click that. So we can see here, geopolitical risk is coming up top, macroeconomic risk, as Melissa was talking about, also a big concern for a lot of you out there. I'd be interested to see what the other is that people have picked, but we've also got misinformation and data risk, and we're going to be touching on that topic as well. So some interesting results there. Now, Jon, why don't we go to you from what you've seen in the audience response there? Is that the kind of thing that you would expect to see?
Yeah, I think generally that kind of fits with where our head is in, looking at this upcoming year as well as what we've learned from the previous year. Last year, we had one of the big mistakes that we had made is that we were not, at the beginning of last year, we were not thinking outside of the box in terms of where are the traditional volatility vectors coming from and where could the new ones be, right? So we were still in this sort of maybe the status quo mindset of, looking at equity-based indicators and futures indicators and looking at interest rates and looking at currency, which is very important to do. But we missed this entire sector where we live in a world now where the efficiency of communication is basically frictionless. And what that means is that a very small group of people can connect with huge numbers of people. And that creates a new type of volatility event that we hadn't considered, which is what we're calling crowdsourced volatility. If you go back and you look at the Reddit stocks, that was a perfect example. We managed through that volatility, I thought, exceptionally well. There was a fair amount of planning, but honestly, a little bit of luck. And we'll take that luck all day long. We didn't execute perfectly, but we managed through that and we survived quite well. But that was a lesson that we need to understand and monitor, crowdsourced volatility. And we've been struggling with that to this day. It's very difficult to preemptively detect where the sources of that volatility are coming from. And this is especially true in the cryptocurrency space. Right now, venture capital is huge in cryptocurrency. The amount of money and capital that is deployed to the cryptocurrency space is at an all-time high. They have reduced the capital deployment rate by half. So there's more money now and they're shooting it out faster than ever before. And when you get that, when you get large amounts of money getting slugged into markets that are relatively immature, you do get this sort of fear of missing out, this sort of crowd-based volatility where everyone's like, doesn't really understand what's going on, but they see the money. So everyone starts magnetizing towards it and start twittering stuff, and they're in Discord channels, and it's almost impossible to track what's going on. So it's really hard to figure out where the next bump is going to be. And there are lots of ripples in the market with this stuff. So that's really kind of the main thing that we're trying to keep in mind. And where do you put that? Do you put that in misinformation risk? Maybe. Where else do you put that in traditional market volatility risk? Sure. So that's where we're looking. And the other part is, traditional geopolitical risk, right? I saw that was a big chunk. I think, the Eastern European conflict is a prime example. We're concerned about that at TradeStation as well. In addition, if you look back to last year and still a little bit now, we have the Evergrande issue in China, where there's just tremendous amounts of commercial paper that it's difficult to track. We're not exactly sure how much is out there, how much is being defaulted on, if it's being defaulted on, and then where is that commercial paper living? Is it in what funds has it gotten into? Where's the contagion? There are even some stable coins that are based off of traditional fixed income products like bonds and commercial paper, and there's fears that there's Evergrande paper inside the collateralization vaults for certain cryptocurrency stable coins, which is really hard to track because there's no regulatory requirements on disclosure for a lot of the stuff. So we're in a new world, and it's sink or swim, and we're doing our best, and it's all about data and information.
It does remind me slightly of the pre-global financial crisis and derivatives, right? Not understanding what you're holding and having a lack of transparency.
Right.
And this is...
Yeah, I'm having PTSD flashbacks to that. I was just a kid back in the day during that, but I learned a lot, and it feels very similar. But it is different. So I wouldn't say we could look back and perfectly replay 2007 now, but I certainly have that feeling in my gut, right?
Certainly, yes. And I think regulators are worrying about the same thing, given how much discussion they've been having. Actually, also about the topic of, you mentioned GameStop and Reddit. That's been a big topic this side of the pond and in the US. So the SEC, I know, has been talking a lot about it over recent weeks. Now, Chris, I'd like to bring you into the conversation. Well, how does your sort of experience jive with what we've been talking about so far?
Yeah, thanks, Virginie. I mean, I'll just go back to using data, whether you're using it for, alpha generation purposes or risk. I think that risk teams, there's no excuse anymore to just kind of sit behind your Barra or your Axioma model and let the factors kind of neutralize themselves. I think risk is taking a much more active approach. Take the Reddit stocks, for example. Hedge funds, just like people, like to chase shiny things. So the retail people start to chase these stocks, and hedge funds started to chase them as well. So hedge funds started to chase the data that could gain insight to those stocks. So that could be retail trade flows. It could be these Reddit investment forums. And what risk teams need to do is make a decision. Do we play in these names at all? Do we hedge those names? Or sometimes they just take them to zero. So I have clients who said, we want the top 10 stocks talked about on Reddit. We have a strategy for that. Maybe they're front running or kind of fading these spikes in the market. And then other ones who just wanted nothing to do with it said, we'll just take it to zero. If AMC is hot today, we're making sure that no portfolio manager in the entire firm has it. So that's one example. And then I think news and social media. 4, 5, 6 years ago, you had a bunch of social media companies come and go. There's a few that have stayed around. And I think that between news and social and some view into the retail market, whether you're building that algorithm yourself, every time somebody buys, some odd lot number, maybe you flag that as a retail piece. I think that type of data is here to stay. So it'll ebb and flow, right? That's the ensemble model that my Battlefin friends push all the time, is you need to have these data sets in your 4 walls, because by the time you need them and don't have them, it's too late. So I think in terms of risk management, it's just having, filling out these blind spots, and there will be more blind spots this year. SPACs is another example that came and went. They had a huge uprising, then there was a huge short interest craze when these had started to become redeemed. And I think that's something that people need to keep an eye on. So either have a strategy for these names or avoid them completely.
Sure, some good advice there. And Elliot, I'd like to bring you into this, obviously, from the data perspective. Data and misinformation risk is something to be very worried about. How are you seeing firms sort of tackling this issue?
Yeah, I mean, at FactSet, we're in kind of a privileged position because we have been a trusted data source for about 40 years. So we've got a lot of experience of how clients approach us in terms of how we can help them in that challenge. Even a few years ago, the type of content that was available was fairly limited compared to what it is now. So we've seen a proliferation of alternative data vendors coming to the market, even in just the last 3 or 4 years. And I think one of the challenges for our clients is, among many others, is in their data sourcing workflows and processes, knowing which data sets that they can trust in terms of the quality, the accuracy, and the sources that the vendor is using. I think it's fair to say we see some very highly sophisticated clients quite happy to work with some of this raw, unstructured content from the social media outlets that Chris was talking about, Reddit and so on. These tend to be a little bit more focused on where those sort of sources really do drive the market, especially if you look at China. It's very much retail investor driven, but the large majority don't want to take the risk of handling that data, and probably more so not so much the work involved to try and discern signals from it, because it is so messy, and they just don't have the resources to do it. So that's where we think the proliferation, the rise of marketplaces such as FactSet, as well as many others now, offering different levels of service around that data discovery and understanding. Some provide a full integration service like we do, but some provide more of a scouting service, which gives a very broad range of data vendors across the market from which to understand from. And I think that's come to the aid of our clients hugely. Now they don't have to go and scout the whole market on their own with their own sort of researchers. They can come to a marketplace or a data scout to help find them a validated set of content. So I think one of the overlooked benefits of all of those marketplaces is that if you're in the business of collecting and selling data, you take data quality and data preparation very seriously, because it's your bread and butter. If your data is wrong, then especially with today's social media outlets, people soon know about it. So I think the fact that if you are doing a full integration of vendors, of third parties' data, if you're applying the same sorts of standards as you do for your own data, which we do at FactSet for our third parties, that should give those firms a good level of comfort that the data they're looking to procure, which may be a little bit out of their comfort zone or something they've not used before, they'll hopefully have that trusted aspect to it there. We can't guarantee the complete accuracy or integrity of data, obviously, but we provide that level of quality assurance that hopefully helps firms feel a bit more comfortable, at least creating sort of a short list of vendors that they want to look at. But what we've also seen, especially in the last couple of years, is the emergence of, I guess you would call them service integrators or data integrators, who are taking on some of the responsibility of this vetting process on the direct request of clients. So we've seen this quite a lot in Japan. Some of the big banks there are looking to these service integrators to basically offload all of that due diligence work. So they're using marketplaces, obviously, as a first port of call, but they're adding an extra layer quality assurance and more in-depth analysis, probably doing some more sort of use case based testing on that data, which is probably more than we wouldn't have the resources to do that. But if you're paying an outsourced provider company to do that, again, that's another layer of trusted evaluation that the clients can take. So I think the tools are there now for our client base to take the right choices and be able to experiment with that level of trust that perhaps they wouldn't have had certainly 3 or 4 years ago.
Sure, makes perfect sense. And we can't talk about data and data challenges without bringing up the ever popular topic of ESG and how to deal with ESG data, because that's sort of a thorny area that many firms are grappling with, and the spectre of greenwashing for that matter. Melissa, in terms of your view on how firms are sort of tackling that area, how is this influencing their data strategies, the ESG factor here? Well,
you're absolutely right that it's not just about what the company says it's doing. Because this issue of greenwashing has become so big. We think one of the trends for this year to hopefully start to move away from greenwashing, but also ensure that you're actually making an impact, is to look at modeling some of these variables, modeling climate risk, being able to stress test the impact of climate change. So I think one of the issues that investors really want to know about is what's the financial impact for my portfolio, but even at the individual company level. So if we're moving towards net zero, how do I measure what that's going to cost? And that's becoming, I think, a huge part of the data needs certainly of investors in sustainability strategies. So we've been actually doing a lot of work on the idea of how do we stress test that? First of all, how do we determine what the financial impact is going to be? And then how do you stress test it? Because that's actually a much more difficult kind of stress test than if I wanted to stress test, say, the impact of higher interest rates. On the issue of greenwashing, which I think is coming, becoming more and more important and, kind of into the mainstream, as we've seen some companies have issues with it. I think, there's maybe one simple solution, which is just to start with meaningful metrics. So you've got your fund has some kind of stated objective and the metrics, and you've got to state the metrics that you're going to use. So basically say what you're going to measure it, and then use those measurements in your investment process. But one of the difficulties, I think, is really the evolution of market standards and really regulatory standards, and which makes that, kind of increasingly difficult. And so, that's just something you've just got to keep a watch on. You need to be flexible. You need to say it might have been good enough a couple of years ago to just screen out the bad actors. But if I really want to make an impact, I really have to focus on not just what a company is doing, something that is, considered sustainable today, but, that either will be considered sustainable tomorrow, or that we can measure that there is some impact. I think for firms looking to avoid kind of this greenwashing label, one of the key issues is to have internal oversight. For example, having an ESG audit committee or ESG governance committees, and I think so. I don't think greenwashing is inevitable. I think there are ways to avoid it, using data and, kind of using things like a governance committee to ensure that it's being put in place.
It's interesting you mentioned that. I mean, today, in fact, the European Commission has just confirmed it's including nuclear and natural gas in its green bucket, which I don't think every regulator is going to agree to, globally. So you're going to have to look at the sort of greenwashing aspect per jurisdiction, per regulator, per entity. Yeah. It's very complicated from that perspective, right? It's not a simple one to think about, most certainly. And as we're talking about, I think nearly every buzzword under the sun so far, we haven't mentioned crypto assets and the metaverse. So let's jump into that with you, Jon. How is this? How are those sort of developments in the crypto space? How are they going to influence the risk space going forward in this year?
Yeah. So that's a good question. So like I said earlier, the speed of growth in the crypto space is truly tremendous. It is unbelievable. And to that end, being a retail cryptocurrency broker in the United States, one of our largest risks that we're managing right now is the regulatory risk. So I think it's safe to say, in general, across the world, the governments of every country, all the different jurisdictions have a complete range of regulatory realities when it comes to crypto. On one side of the scale, there's absolutely zero recognition that crypto is even a thing. Like, for example, in Thailand, I think there's only 2 cryptocurrencies that the Thai government formally recognizes as existing, and any other cryptocurrency isn't a thing. So there's no taxes, there's no regulation, there's nothing on any of those other cryptocurrencies. And on the other side, you have jurisdictions like the United States that have ambiguous federal guidance on what are you supposed to do, who are you supposed to work with. Should we just model everything off of what the SEC does, or are we in a whole new regime here? So when you have those ambiguous situations, it's very difficult for financial operators to know where they live in that space. So in the United States, the federal government has pushed all of the regulation through inaction. Frankly, they pushed it down to the state level. So you have to follow state cryptocurrency regulation based on where your customers live. So we have customers in all the states in the United States. So we have all these jurisdictions to try to manage, to match up, to figure out, okay, if we behave like this, what percentage of all the states do we comply with, and should we just shoot for the most difficult one? Which is the most difficult state to deal with? So that's very difficult and quite a challenge to work with, because you have this confederation, this hodgepodge of rules that you have to work with. Furthermore, the regulatory guidance across the world is constantly evolving. I believe Estonia yesterday, or it was last week somewhere, Estonia, prior to this new regulatory change, was one of the most crypto-friendly countries in the world. Now it's one of the most draconian in terms of regulatory guidance. So Estonia flipped from one end of the spectrum to the other. And my heart goes out to any Estonian, crypto firms that were operating, because they either have to cease operations or leave the country now. So it's like, and that happened overnight. So that's the big risk, right? Where do you stand in the regulatory regime? Is it going to change? Is it even relevant? And it's just this constant source of stress, right? But outside of that, I think there's strategies to deal with that and whatever. So people are managing that as best they can. But outside of that, kind of in that same vein is KYC risk, right? So know your client, or know your customer. I think a lot of firms have a pretty decent grasp on what KYC looks like in traditional equities markets and traditional regulatory environments. But it's, again, since crypto regulations are evolving so rapidly, what may have checked the box for KYC last year might not check the box for this year. So there's this struggle of, do we cast an exceedingly wide net of KYC when we catch customers in the front door at first, and we get more data than we actually need and impact the customer experience there? Because some people are turned off when you really get in there and like pull a lot of personal information out. They're like, well, okay, maybe I don't want to trade with you that. And then, or do you just hope that in the next coming years, you don't have to go back to your existing customer base and ask for more information? For example, we just had to check for a whole bunch of Estonian citizens in our customer bank. Just look, that wasn't something we ever anticipated we would need to do, right? We've also had to look for a lot of Chinese citizens and look for, different customers in different states, right? So you either can have the data to deal with this constantly changing field, Or you can take, you could follow the lead of like Binance US, which is a large cryptocurrency exchange. They've actually banned doing business with any resident of the state of New York. New York has one of the higher, more stringent cryptocurrency regulations, and Binance US just said, look, we can't comply with New York, so no business with New Yorkers. And that's a huge, huge market in the United States. So, you know, there are massive impacts to revenue if you are not able to obtain the data, maintain the data, and harness the data in order to stay on top of the regulatory curve.
Sure, and then you've got the sanctions regimes on top of all of this that makes it even more difficult, right? Chris, did you have something to add?
Yeah, I mean, just to tie crypto into the ESG and sustainability discussion, I've seen a couple of big names like Kevin O'Leary, Elon Musk have commented on it. The sustainability of, if I'm buying a Bitcoin on Coinbase, I don't really know where that came from. Did that come from some Bitcoin mine that was being powered by a coal power plant in China, or did it come from a small renewable energy startup here based in the US? So I think that will become a trend, because if you have Bitcoin on your balance sheet, for example, or other cryptocurrencies, someone with a real ESG focus can say, was that mined sustainably? And unless you have a real chain of custody on where that piece of that Bitcoin came from, you can't meaningfully say that. And the only way to do that is to really work or invest in these miners that are, maybe they're mining it using solar energy or something like that. So I think that's something that could come to light in the next year or two. The idea of like a clean Bitcoin versus a dirty one almost. I've seen a lot of focus on that. And with continued ESG, I think the greenwashing in the ESG space, a lot of these firms are just kind of buying up carbon credits and then going about their business. So there's meaningful debate whether purchasing these credits actually reduces emissions at all. So I think that's something that will continue to be a focus, especially as institutions continue to get into it. Because if I buy Bitcoin on Coinbase, it's not a big deal for me personally, but if an institution is buying it and they have sustainable investors, it's a much bigger deal. Pension funds, it's even more magnified.
Sure, certainly. And the divide between ticking an ESG box and impact is an interesting one, because sometimes there's a huge disparity between those two things, right? So I'm sure that's something we'll have to get our heads around going forward. I'm conscious of time, so I wanted to sort of well, we're going to get to a few audience questions, hopefully. But before that, are there any new areas of risk on the radar that we need to keep an eye out for, Elliot?
Yeah, when I was thinking about this, there are a couple of areas that sort of sprang to mind that I wouldn't say are necessarily new, but they've really been elevated in the last couple of years. So I think supply chain risk is one that we've seen really in the last few months. That's been on clients' radars for a long time. I always thought it was a client story is a fairly nice to have area of content or data to be able to utilize. But I think it's become especially critical now to understand where firm supply chains are being disrupted as we attempt to reboot after this pandemic, or while we're still in it and identifying dependencies on suppliers, customers, etc., the risks of those and the revenue dependencies around them. And that's I think that's really key for clients to analyze that. But I think what you can also overlay that, and it's kind of indirectly related, is climate risk. So again, that's not a new trend. That's climate risk, and the greenhouse gas story has been going on for 40 odd years, if not more. But it's been bubbling away a little bit under the surface, I think, for that time, and it's been denied by a lot of people, obviously. But since COP26, and I think some of the extreme weather events of the last couple of years have really shown that something is happening out there. Clients are really paying a lot more attention to the location of companies' assets, so their facilities, manufacturing, warehouses, etc. And companies are, if they're able to get down to sort of geolocation, street level of where those facilities are based, they're now able to map that against the types of climate data that we were able to collect. So risks of tornadoes, storms, floods, etc. And also backed by that, the fact that we're able to now look at for climate forecasts using different scenarios, so different temperature increases. So if clients can predict where they think these events might happen more in the future and overlay that against a firm supply chain where they have their big manufacturing plant on the coast somewhere, those are factors that I think they'll start to take into consideration, and that should become more transparent with regulation. So TCFD, for example, is regulation that's coming in specifically around climate change. That's being adopted starting with the UK in this April, and that's going to make the reporting of companies' preparedness for climate change much more transparent. I think one thing that is new, and one of the trends we've spotted over the last sort of year or so, or a little bit longer, and I think really still in fairly early stages in terms of clients actually considering it part of their investment process, is around what I guess I would call lack of diversity risk. So I think since 2020 and you know the reality of inequality was presented to a global audience, we saw a remarkable shift in corporate attitude and culture to address lack of diversity, and that wasn't just around the presence at board or executive management level, I think, where the imbalance has always been most obvious, but throughout the whole workforce. So we can see some strong signals in that just through actually one of our partners on Open FactSet called LinkUp. They scour corporate websites every day for job postings, and what you're able to do with that content is look at specific job titles and see how they're trending. So anything around diversity and inclusion. So we've seen a lot of companies employ a CEO of diversity in the last year or two. You can now see that trend. Even before 2020, it was fairly low in terms of the number of postings for that type of role, gradually increasing. But since 2020 and mid 2020, that has massively increased. It's 3 or 4 times higher than prior to those events. So I think those, as the scope of ESG especially expands more into that area of governance or social responsibility for corporates, companies that aren't addressing that risk, that diversity aspect, would potentially be seen as laggards in that space, in the ESG space, and that will obviously mean that they're not included in ESG related ETFs and funds, etc. And I think that's a significant risk. I do believe it isn't really being considered that much yet, but we're seeing more interest around from our clients. And the final one is more of it's kind of related to what John and Chris have touched on in terms of cybersecurity, cyber risk. That's an area that's coming up more and more, thanks to obviously some fairly high profile breach events over the last couple of years, but also I think this metaverse concept is obviously going to start trending and getting more traction, and that will potentially open up new attack surfaces, I think, for cyber criminals. So as a result, we hadn't really had any vendors approach us in terms of their cybersecurity offerings. We've suddenly had 2 reach out to us in the last couple of months or so. So that's for us is a strong signal that that's being taken much more seriously on the vendor side, and obviously clients should think about starting to address that in terms of assessing their portfolio for that type of risk in the future.
Sure. On that point, I mean, the regulators are nigh on obsessed at the moment with operational resilience. It's being embedded into nearly every piece of regulation I've seen. So that certainly is something from a regulatory risk perspective too. Chris, did you have something to add?
Yeah, I mean, just on the regulatory front, to tie it back to data a little bit, the SEC came down on a couple of firms. We don't have to mention them by name, but it's ever increasingly important that the same way that John was talking about, crypto custody, you need to, KYC, it's the same thing, know your vendor. You need to know where this data comes from. And you can kind of tell, there's a sniff test with firms. When you get them on the phone, they don't fill out this compliance paperwork, it's probably best to find a competitor, because there's no data set that's worth the reputational risk for a hedge fund to kind of look the other way on some of these compliance questions. So I think that's going to be an area of focus. It's definitely a focus for the SEC. I know my clients on the hedge fund side have been audited by the SEC specifically around their alternative data policy. 5 years ago, the SEC, nobody was talking about it in the government, alternative data, and now it's kind of becoming mainstream, which I think it's good for the industry. It shows a little bit of maturity, but it also will weed out some of those vendors who play in gray areas. And the ones who have been addressed by the SEC, you could argue, some would argue that they're the cleanest, right? They went through a huge compliance process sooner than some of the other ones have. So not to say that those firms need to be avoided, but I think as a hedge fund and as a vendor, you need to have real policies in place. And one other thing that I think will come into place, I mean, hedge funds are very buttoned up with this in terms of personal trading. So when I was on the hedge fund side, there was a myriad of regulations that made it basically impossible or unfavorable for me to ever buy a single share of anything. Congress does it, the Fed does it, but a strategist at a hedge fund can't. And the ironic thing is that a lot of vendors can. So if you have a data set that has insight into Uber, there might not be something restricting you from trading Uber. So I think once the SEC catches wind of that, they might put out some new compliance guidelines on that. I think that's a large risk for this coming year.
Sure. I mean, the SEC has sort of about 90 odd different items that it's working on at the moment. So I think regulatory risk is top of the list for a lot of firms.
They're hiring.
Yes.
So
they certainly are. It's an interesting one, and such a wide variety of topics, including transparency and securities financing, which is going to be an interesting one to see implemented, particularly from the hedge fund perspective. And with that, I'd like to say thanks to the panelists for an interesting discussion. Thanks for attending to everyone else out there for the Data Minds event that's sponsored by Wall Street Horizon. If you missed any of the session at all, don't worry about it. We'll send you an email with a recording early next week. And with that, I'd like to wish you all a good rest of your day, and thanks to everybody.
thank you.
Thank you.
Thank you.
Thank you.